Irish whiskey producers are facing a significant challenge as a 15% tariff on exports to the United States is set to take effect. This tariff, an increase from the previous 10%, is part of broader U.S. trade measures impacting European wine and spirits. Industry leaders, including Michael Scully of Clonakilty Distillery, have expressed concern over the potential impact on sales and employment as the U.S. market accounts for a substantial portion of their exports. The sector, already under pressure due to recent liquidations, is urging European negotiators to prioritize a return to a zero-for-zero tariff arrangement, which has been in place since 1997. The tariff increase is expected to lead to higher costs for both exporters and consumers, potentially affecting sales volumes in a currently soft U.S. market. The Irish Whiskey Association and the U.S. Distilled Spirits Council have both called for expedited negotiations to revert to zero tariffs, emphasizing the potential economic benefits for both regions' hospitality industries. As talks are set to continue into the autumn, the industry is seeking government support to mitigate the impact and explore alternative markets to offset potential losses in the U.S.
Carvana NYSE CVNA experienced a significant stock surge, rising 16.7% following its impressive second quarter earnings report, which exceeded market expectations. The online used car retailer reported a 42% increase in revenue to $4.84 billion, surpassing the estimated $4.59 billion, and a 41% rise in unit sales to 143,280. This strong performance led to a 70% increase in adjusted EBITDA to $601 million, resulting in an EBITDA margin of 12.4%. The company's GAAP earnings per share also saw a substantial jump from 14 cents to $1.28, outperforming the expected $1.14. Carvana attributed its robust growth to operational efficiencies, including the expansion of its car selection by 50% and the integration of 12 ADESA sites into its network. These improvements reduced transport distances and costs, bolstering profitability. CEO Ernie Garcia highlighted the company's unique, vertically integrated business model as a key driver of its industry-leading growth and profitability. Looking ahead, Carvana anticipates a sequential increase in retail units sold and adjusted EBITDA, targeting an adjusted EBITDA of $2.2 billion for the full year, up from $1.38 billion in 2024. With its sights set on selling 3 million cars annually, Carvana is well positioned to capitalize on the expansive used car market.
Nuvve Holding Corp., NASDAQ, NVVE, a leader in vehicle-to-grid technology, has partnered with DeFi Technologies to manage its Hype Treasury, marking the launch of DeFi Technologies' new DeFi advisory business line. This initiative involves utilizing Hype, the native currency of the hyperliquid decentralized exchange, to optimize Nuvve's treasury strategy. Through its subsidiary Stillman Digital, DeFi Technologies will provide institutional-grade services such as performance optimization, custody, and over-the-counter transaction execution. This strategic move by DeFi Technologies underscores a growing trend among publicly traded companies to explore digital asset strategies, reflecting a broader industry shift towards decentralized finance DeFi solutions. The collaboration highlights Nuvve's commitment to digital innovation and positions DeFi Technologies as a key player in the realm of digital asset management for corporate treasuries. The compensation model for DeFi Technologies is performance-based, with fees paid quarterly in either cash or stock, contingent upon assets under management. This partnership could potentially influence market sentiment by demonstrating the viability and benefits of integrating DeFi solutions into traditional business operations. As more companies explore similar strategies, the demand for compliant advisory solutions is expected to rise, potentially driving further growth in the DeFi sector.
Wallbox NYSE WBX has announced a strategic partnership with Leap to launch its first virtual power plants, VPPs, in California and New York. This initiative marks a significant step in Wallbox's commitment to creating distributed and intelligent energy ecosystems. By utilizing Leap's platform, Wallbox manages energy flows and aggregates thousands of home EV chargers, effectively transforming residential infrastructure into a dispatchable grid resource. This not only enhances grid reliability by connecting Wallbox chargers to real-time energy markets, but also incentivizes users with financial rewards for charging during off-peak hours. The launch of these VPPs is expected to improve grid dependability and flexibility, as emphasized by Esteve Dolce, Wallbox's general manager for North America. The initiative is part of Wallbox Rewards, a smart charging program that promotes grid flexibility. Christy Dodge from Leap highlighted the adaptability of EV chargers in meeting energy demand. The program is already operational in New York and California, with plans to expand to Texas later in 2025. This development positions Wallbox as a notable player in the EV charging sector, although some analysts suggest that AI stocks may offer faster and higher returns.
In August, the outlook for U.S. mortgage rates suggests they may remain stable or experience a slight decrease, influenced by the Federal Reserve's current stance on short-term interest rates. The market anticipates no changes in the federal funds rate during the upcoming September meeting, although shifts in inflation or employment data could alter these expectations. Mortgage rates, which are tied to long-term inflation expectations, could be affected by unexpected economic developments or policy changes, including trade policies and political influences from the Trump administration. Currently, the average rate on a 30-year mortgage has decreased slightly to 6.72%, providing modest relief to potential homebuyers amid high borrowing costs and rising home prices. The 15-year fixed-rate mortgage also saw a minor reduction. Despite these decreases, rates remain significantly higher than pandemic-era lows, continuing to impact the sluggish U.S. housing market, which has been in a downturn since 2022. The 10-year Treasury yield, a key indicator for mortgage pricing, has slightly decreased, and the Federal Reserve, led by Chair Jerome Powell, has indicated that no rate cuts are expected soon due to ongoing inflation concerns. Forecasts from key mortgage-related organizations diverge, with Fannie Mae predicting rates may fall below 6.5% by year's end, while the Mortgage Bankers Association, MBA, expects them to remain above this level into next year. Economists generally predict that 30-year mortgage rates will stay above 6% for the remainder of the year, with a potential easing to around 6.4%. The broader economic context, including trade policies and political uncertainties, adds complexity to these forecasts. The housing market remains sluggish, with pending home sales down 0.8% in June, indicating potential further declines. Even minor decreases in mortgage rates could be positive for prospective homebuyers, though substantial reductions are not anticipated in the short term.
The U.S. Environmental Protection Agency, EPA, under the Trump administration, has announced plans to relax regulations on vehicle emissions, marking a significant shift in the government's approach to environmental standards. This move includes revoking the 2009 finding that identified carbon dioxide and other greenhouse gases as harmful to public health, which would undermine the legal basis for limiting emissions from vehicles and power plants. Additionally, the administration's new tax law aims to eliminate incentives for electric vehicles, EVs, such as the $7,500 credit for new EV buyers, and removes penalties for automakers that fail to meet federal fuel economy standards. This regulatory rollback could significantly impact automakers like Tesla and Rivian, who have benefited from selling emission credits to other manufacturers. The implications of these changes are profound for the automotive industry. By removing financial penalties and incentives that encourage the production of more fuel-efficient and electric vehicles, the regulatory adjustments could slow the industry's transition from gasoline-powered vehicles to EVs. The Biden administration had set ambitious emissions and mileage targets to reduce fossil fuel usage, but these are now under threat as the National Highway Traffic Safety Administration, NHTSA, is pressured to weaken these standards. The absence of penalties for non-compliance might lead to increased production of less efficient vehicles, potentially raising consumer fuel costs and benefiting traditional oil industries. However, experts suggest that while automakers may scale back immediate EV development, they are unlikely to abandon long-term electrification strategies, anticipating future regulatory shifts.
Cameco Corp., a leading uranium miner based in Saskatoon, reported a robust financial performance for the second quarter, significantly surpassing analyst expectations. The company announced net earnings of $321 million, a remarkable increase from $36 million in the same period last year. Adjusted net earnings reached $308 million, up from $62 million, while EBITDA earnings before interest, taxes, and amortization soared to $673 million, exceeding projections of $629 million. This surge is attributed to its 49% stake in Westinghouse Electric Company and strong results from its uranium and fuel service operations. The global uptick in uranium demand, driven by jurisdictions worldwide seeking to power nuclear reactors, has bolstered Cameco's financial footing. CEO Tim Gitzel highlighted the company's strategic positioning to capitalize on the growing nuclear power sector, with plans for small modular reactors in Ontario and new reactor projects in the U.S. and Europe. Despite lower production at Key Lake Mill due to maintenance, Cameco remains optimistic, projecting substantial uranium output from its McArthur River, Key Lake, and Cigar Lake facilities. However, Gitzel noted the industry's challenge in securing sufficient uranium to meet long-term demand, emphasizing the necessity for utilities to secure more fuel by 2045. The company is also exploring additional mining opportunities, though it faces potential risks from labor shortages and equipment commissioning challenges, exacerbated by wildfire threats impacting workforce availability.
In a significant development for financial inclusion, new research from the University of Notre Dame highlights the potential of using retail transaction data to establish credit scores for individuals lacking formal credit histories. The study, titled Who Benefits from Alternative Data for Credit Scoring? Evidence from Peru, demonstrates that retail data can substantially increase credit card approval rates for no-history applicants from 16% to as high as 48%. This approach, spearheaded by Jun-Hyuk Yang and his co-authors, leverages everyday shopping data to break the traditional lending cycle, which often excludes unbanked individuals due to their lack of credit history. The research, conducted in collaboration with a Peruvian retail company, analyzed the shopping behaviors of over 45,000 consumers. By integrating retail data with traditional credit data, the study created alternative credit scores that proved more predictive of credit risk than conventional methods. This innovation could be transformative for financial systems, as it offers a scalable solution to enhance credit access without increasing default risks. The findings are particularly relevant for policymakers and fintech companies striving to bridge the credit access gap, as they suggest that retail data can serve as a critical tool in fostering more inclusive financial environments.
Lucid Group Inc., NASDAQ, LCID, alongside several mining and processing firms, has signed a Memorandum of Understanding, MO, with Alaska Energy Metals Corporation to form the Minerals for National Automotive Competitiveness (MINAC) initiative. This alliance, which includes companies like Graphite One, Electric Metals USA Inc., and Recyclico, aims to bolster the U.S. automotive supply chain by utilizing domestic mineral resources, thereby reducing dependency on foreign imports. The initiative aligns with the Immediate Measures to Increase American Mineral Production executive order issued by President Trump in March 2025, emphasizing the strategic importance of local resource utilization for national competitiveness. The launch of MINAC was attended by prominent political figures such as Governor Katie Hobbs, Diaz, and Senator Dan Sullivan, RAK, highlighting the political and economic significance of this venture. Gregory Beischer, CEO of Alaska Energy Metals Corporation, emphasized the broader benefits of ethical domestic sourcing, including enhanced U.S. defense capabilities and job creation. This initiative is expected to have a positive impact on the local economy and regulatory environment, while also potentially influencing the stock performance of involved companies like Lucid Group by strengthening their supply chain resilience and operational efficiencies.
Photowadio Renewable Ventures, FRV, part of Jamil Energy, has announced a strategic partnership with Envision Energy to develop the hydrogen Cambuco project in Brazil. This collaboration aims to establish a significant green ammonia production facility at Pequim Port, leveraging Envision's expertise in integrated renewable energy solutions and FRV's extensive experience in sustainable energy. The project will feature a 500 megawatts electrolysis facility and an integrated ammonia plant, expected to be operational by 2030. This initiative is part of Brazil's broader strategy to position itself as a leader in the green hydrogen sector, aligning with its commitments as the host of COP30 and its focus on developing a low-carbon economy. Envision Energy, known for its integrated renewable systems, will contribute its cutting-edge technology and experience, as demonstrated by its recent achievements in China, to this landmark project. The partnership underscores the strategic importance of Brazil's geographic position and its commitment to energy transition, aiming to supply green ammonia to key markets in Brazil, Europe, and Asia. The collaboration not only enhances Brazil's green energy infrastructure, but also serves as a model for global energy transition efforts, emphasizing the significance of renewable hydrogen in decarbonization. This development is poised to bolster market confidence in Brazil's renewable sector and could influence global market dynamics in green energy solutions.